Welcome back to Be Great Economics. This is Nate. Let's get started. Oh man, it has been a crazy couple weeks. So this last week was rough. I chipped a tooth. I got in my first car accident. Don't worry, no one's hurt. In fact, you can't see any damage to my bumper. I have a steel bumper, so it's the other guy that I backed into at a half a mile an hour from 1 foot away. So uh, I got told I got to get out of my apartment or my house that I'm renting because the landlord's coming back. Man, it has been rough. Oh, and the Nasdaq fell massive amounts. 15% hit our price targets. It is an absolute bear war on the pig fat cows, the bulls here. Um, man, I don't know. Maybe I should make Russia the bears, 'cause the Russian bears, and also they end up winning the war in the end against Germany, so that would be a better example here. But overall, it's just everything is going absolute chaos. It is just shock and awe, fast moving action. But I think we're going to see a reversal here soon, so we're going to talk about that. I made this into slides to condense it as much as possible and give you as much information as possible. If you like the memes, I was told I have to have memes in here, otherwise other people won't watch. If you don't, oh well, I like the memes. These are original. I make garbage memes. So let's talk about the S&P 500. So far, we have fallen 12.4% from the top to the bottom. We followed this exactly on Wyckoff distribution. I had been following this for over a month, and once we started seeing it was absolutely distribution. It was all about volume, and we hit that volume, and we went through the selling points, right? So if you were watching and you wanted to hedge, the triggers were the volume hitting as we hit the bottom line and the consolidation occurring back at the beginning of January. And it absolutely played out. So for anybody that was watching, I hope you attempted to hedge. And if you didn't, it's okay, right? This stuff happens, man. I have lost so much money not hedging. You got to learn to do it. I still lost money because my hedges were still pretty small. But you got to learn to do things like hedging when you know something is going to occur or has a really high likelihood. Once those risks go away, you can kind of drop off the hedges. It's cheaper to lose a little bit on hedging than it is all the amount of money that you lose not hedging. So it's okay, but we're going to learn through this. Now, a lot of people said this has been absolute slaughter and absolutely crazy. And quite frankly, yes, it's been nuts. But at the same time, go back to most of the major crashes over the past 3 years, this isn't that bad. 12.4% in 20 days, 21 days, right? 16.61 at the beginning of March 2020, right? And then we fell much more drastically. And you go back 2018, 2019 during those rate hike taper tantrums, much worse, much worse. So far, this isn't insane, but we did break below our long-term support band for the lower end that we established as a counter to the top. Now, if we're rejecting off of this, we can go lower. But I'm going to show you a couple metrics why I don't think necessarily going much lower in the short term is necessarily immediately feasible. I have more bias to the temporary upside at least. So a couple reasons. You usually get a dead cat bounce in traditional stock market indexes. In the S&P 500, we typically get a dead cat bounce, and I'll run through a couple of these scenarios. If we get a continuation of, say, March 2020, right, we're going to come up somewhere along these pricing lines, and we're going to at around 4,700, 4,800, and then we'll come back down, right? If that's what we're going to do, and we're just going to go for the floor as fast as possible, then yeah, okay, totally feasible, right? As traders often, people like to make fun of traders often. Again, I'm not a trader. I am just an investor who likes to hedge and use TA. But as people like to mock traders, oh, it could go up, down, sideways. Great, thanks, guy. Yeah, well, at least we're not going back in time because, well, I guess it'd be better if I could, right? But it could go up, down, sideways. But here we're going to lay out some of the odds and why certain things are more likely than others. No matter what scenario, almost all of them are going to point to we're going to go up somewhat. And that's mainly because we're extremely oversold on the RSI here, right? On the daily and the weekly and the monthly. We are oversold here. So we're going to get some type of rebound. Now that rebound can be a little bit sideways action and kind of dull. So, watch out for that. You want to watch the volume. You want to see the volume go into a little bit of buying. It can even taper out as long as the price starts moving up with the volume increase and then decrease. So we'll be watching volume. We'll be watching this movement up here. There are three major resistances. This resistance zone. We have this downtrend that'll probably, if we're going to stay down, we'll probably stay below this trend overall, and the uptrend channel that we are below. If we can break through all three of these and set on top of it, that'll establish scenario, green, and scenario blue. The blue is the, okay, we get back in the channel and then we operate like a normal, the index is fine. This one I find to be a little unlikely. I struggle to think that the market's just going to move in a straight line pattern on the same trend at this point, because we're kind of already overvalued. Everything's still crazy. The gambler mentality is still there. I think it's more likely we get a blow off top if we recover. So if we're going to go through a recover and we're going to bounce up, we come off the trend lines and we just start going to the moon, because it's going to be a party, a final blowout, and then we're all screwed. The reason why is generally when rates start to move up, the market tends to melt up with it. And there's going to be a couple reasons why I don't think the blow off top has necessarily happened yet. It doesn't have to happen in 2008. It didn't happen to the stock market. It happened to the housing market. We could say that the speculation went to cryptocurrencies, but we don't necessarily know if we've hit the blow off top, but we haven't seen it in the stock market yet. And so I'm still expecting that to be a probability. So if we do come up and we set above all three of these lines, and then we go up, retest, resumption of the move, and you start seeing volume come in, that's your trigger. That's where things are going to get a little wild, right? Now, not breaking all-time highs can still be a limiting factor, and you want to watch that. You want to keep a tight stop loss as you come into here. So for the traders, and let's be honest, talking this move, this is not investing. This is completely a trade. There is no investing in this move. Okay. These long-term downtrends, you can play some investor strategies on how do I manage my risk and how do I increase accumulation, right? Because if you believe the S&P 500 is going to have a value point somewhere around $3,800, $3,500, and that's where you want to start accumulating, you're going to start looking at how does this play out, right? Now, worst case scenario for the stock market is this red one. And the reason why I say it's the worst case is because if this purple one plays out, you're going to see the Fed start to come in really soon. And I know like people like Kevin Paffernath are saying, oh, the real Kevin, meet Kevin, sorry. The Fed isn't there to keep up stocks. Well, remember I showed you the equation that they use to establish employment and prices, right? If they want stability, investment has to stay up. If you get massive sell-offs like this in that purple line, you're going to start getting deflationary function. That's going to show there's a liquidity crisis. If that liquidity crisis, we're not seeing it yet, but if that liquidity crisis presents itself at a really very, very fast drop, that's the signal to them, because they see money as a commodity that has to meet demand. When there's more demand for money, you distribute more of it. This was the 1890s whole problem that they claim was what the Federal Reserve was built to fix, was deflation so evil, right? And the U.S. made a whole bunch of bad choices, including things like going on the silver standard that was bimetal, but they weren't on a silver standard. They just bought a bunch of silver and offered silver certificates that then got swapped for gold. So then there was less liquidity available. So people were defaulting because of faster deflation than usual. It was dumb. But ultimately, they see it as, I will yield to you money because there's not enough money in the system. Now, the red scenario would mean that we're not going to see massive deflationary pressures until it's too late. And so the market's just going to bleed off over time. We're going to keep getting these fake outs on recovery. People think that they're going to go up and it's not, right? This is the 2008 overlay, just so you're aware of how this would play out and why it takes until here till the Fed actually would step in when they start to realize, like, man, this is not getting better, because the deflationary pressures don't hit until the final capitulation. This one hurts the most. So you got to watch out for this too. And that's why these dead cat bounces, we're going to watch these. But the blow off top is, to me, the most likely scenario, because ultimately, even though we're a little low on cash, the deleveraging that's happening here is a distribution. We proved that. This is distribution. Distributions are not blow off tops, and distributions are almost always followed by accumulation. Almost always, if it goes through distribution, the intent of the distributors, the people selling early, was to go and accumulate again. This is even if it's from one party to another, it doesn't matter. The goal was to accumulate, a subconscious group goal. So just things to think about. If we're going through distribution, then we should see accumulation. We are oversold. We should see a dead cat bounce at least. There is a high probability that we see some upside in the short term, and then I think that we go through a final manic blow off top. And I'll show you another slide here as we go through. The Nasdaq's not too much of a thing to talk about because it's just we're hitting our price targets. This is the thing that I did put calls on. I made 120% on these puts, but they were a very small portion of my portfolio. So 120% on like 4% of my portfolio did not compensate for some of the losses this week, which is fine. You know, I hold a lot of gold and silver, so I don't really worry too much. You know, that insurance is something where there's somebody who said for the stability, and I have a lot of positive views on it. But ultimately, I sold these yesterday, and I said that on Twitter. I sold these puts yesterday because I'm trying to build a cash position to then go into something, whether it's catching that dead cat bounce or cross your fingers, long-term, long-dated call options to the moon. Watch these multiples just hit and then just bleed them off fast so that you don't get hurt when it comes crashing down, because it will come crashing down. But Nasdaq's oversold. The MACD is oversold. Now the MACD is a lagging indicator, so we still have these red bar indicators on the MACD, but this can just be a simple indicator that we're about to switch. You know, it doesn't mean this is a lag, right? The RSI is the relative strength currently. This is more of a inaction indicator, and we are seeing that it is oversold massively. We have not seen this type of action since pretty much any major crash. This is where we end up is below 30, and once we end up below 30, we're going to see at least some type of rebound. Now that could be more sideways, and this dead cat bounce could be very weak, so we do have to watch for that. Tomorrow is the FOMC meeting, 25 January, or 26 January, and we want to watch out for what is going to be said there, because we want to see more dovish tone. Now, I think that the meeting minutes can kind of give us, from the meeting 2 weeks ago, can give us a dovish tone, because all they have to do is not confirm that they're going to do the extra things like a fourth rate hike and QT, quantitative tightening, reduction of the balance sheet instead of just a tapering, a reduction of the total purchases made per month. So actually reducing the balance sheet. If they say they're not going to do that, that can be enough to get us moving. But it could also not be enough. Too little, too late fallacy problems from the Federal Reserve. And so all we do is get that dead cat bounce. So just watch out for it. If you get the dead cat bounce and we get confirmation, we go up into some type of resistance, come back down. Like once you start that downtrend, that's where you can start to hedge. You can take those puts again. So if you missed out on these puts, you're going to have more opportunity for long term. You want to do long dated ones for this because this move may not be as powerful. But you can get your extra money's worth on using this as a hedge. So that's why I keep bringing these up, is like this downtrend potential can come through these through this dead cat bounce. But if we break through this support, then we get that blow off top. So again, it was factually Wyckoff distribution. This is usually followed by accumulation. So you want to assume that there's a probability that we're going to go into accumulation. We hit all the metrics here. So next time I'll start putting it on Twitter. I'll show the metrics for accumulation, but you can look them up, and the same. It's just the inverse of the distribution. Just different potentials on the direction. But ultimately, we're hitting our first target. We could go down to our second target, right? I'll go back real quick. Second target is this second line here at 12,800. That's rough, but it could do it again. Dead cat bounce, go down there. By the time we start hitting down here, things are going to start clicking that this is not going well, and this is going to signal more fear. This may not, and if we go too far, we may not go through our accumulation, right? So now let's look at the other cases for a blow off top, right? This is the Nasdaq against the S&P 500. Generally, we would say the Nasdaq should outperform the S&P 500 because it's growth, speculative stocks, and technology outperforming standard of the stock market. Now, there's a little more bleed over than there was back in 2000, but I'm going to show you a couple of quick reasons why I don't think this is the end. So we had an uptrend here in the current past 2 years, and surprisingly, even though all the speculation has been in tech stock, the Nasdaq hasn't really overall outperformed the S&P 500. This is amazing to me that we have not outperformed the S&P 500 this whole time. And we're setting on top of the old all-time high, 3.25, right? We're setting above it. We're still maintaining an uptrend on the bottom, and we have a higher high between these two peaks. Well, really these three peaks, right? Now, if we go to the 1999 and 2000, We see it here, right? In January to June 2000, higher highs. We sustained generally an uptrend with a wick down, so we'll call that pretty close, acceptable. So what if the blow off top is literally double the valuation of the Nasdaq against the S&P? Possible. I don't know how likely that is, getting a 7, but I mean, blow off tops are manic insanity, mostly run by leverage. When we go to the 2000s, right before the blow off top, this one's a little closer in concept. Now, this is on the daily and this is on the weeklies. This is a longer term trend, but which maybe means that our upside lasts a little longer. Who knows? Maybe it doesn't. It doesn't go as high. But when it comes to this uptrend here, we see higher highs, higher lows. We're seeing massive wicks, right? Extreme volatility. People are like, oh, we've never seen this kind of volatility. Well, I don't know. 2000s before and after were both pretty volatile. Now, could it be the end? Possibly, right? Because you also get it over here. Same thing. Higher lows, higher highs, and then we failed into one massive dead cat bounce. So even if this wasn't a blow off top beforehand, we could still capitulate. But this is a pretty easy answer. If we fall below this box, we're going to keep going, right? Because the Nasdaq's going to sell off faster than the rest of the S&P because the S&P has a lot more value-oriented stocks inside of it. Whether or not they are actual value stocks is a lot more debatable these days. So I think that the blow-off top case still exists. It still has the potential to occur, but remember how Bitcoiners have been claiming we were going to go to 100, 400,000, whatever, throughout 2021. Same thing. If you're all calling for blow-off top, doesn't necessarily have to happen. And I don't think that the whole market is saying that the Nasdaq will go through a blow-off top, but there's a probability that it happens. So worth watching. Pay attention. This is a trade and not investment. If you're someone who sees themselves as a long-term investor, I wouldn't really be touching many of these unless you're buying small individual stocks that you long-term truly have a belief in, and you understand their balance sheet and the risks that come with it and what the downside potential is. And understanding the downside potential is usually way worse than you're used to. So we're going to try to run through some of the more macro discussion. Why is this not a deflationary event just yet? We're seeing yields generally rise, getting a little bit of a rebound, and they're not necessarily into a zone where it's going to cause a lot of fear into something like the Federal Reserve, where they're thinking that there's no liquidity. And honestly, if they're worried about liquidity, it's going to drop, right? I saw Macro Alpha post about how if we do see the taper and QT occur, we're actually going to see bond yields drop because the market's going to be dropping, right? So the expectation would be a turnover. We would see a downtrend here, but that would also signal a liquidity crisis. People are seeking liquidity and they don't trust the investments that are out there, but they also struggle with the dollar, so they're buying bonds, right? I know that that's like, but why would you want the dollar? Well, people are getting out of the dollar with hedges, but they rather hold cash than investments. The investments become liabilities, which is another problem with the Keynesian equation, right? The investment, I'll do another video on that, but the investments become liabilities when nobody wants them. So when we go to the US dollar DXY, yes, we popped above this downtrend, but we seem to be wicking right into it. If we come back below and we see an uptrend in stocks, this is not a liquidity crisis. This is not everybody freaking out and trying to get dollars instead of stocks. This is a distribution event where people are just selling. And so this tells me that there's enough liquidity in the system to meet the current demand. Now, the problem with that is if you want the Federal Reserve to come to your rescue, you have to have a currency crisis. You have to have some type of liquidity crisis. We aren't seeing it yet. It's not here. We aren't seeing massive defaults. We aren't seeing massive issues other than just corporations realizing that inflation and currencies have damaged their earnings. They should have accounted for that all through 2022, all through 2021. I don't know how you run a major global corporation you don't account for, currency exchange and hedge against that. Netflix, but it happened. Oh well, they're learning, right? They'll figure it out. They'll buy some gold. Maybe someone will buy Bitcoin. Clearly, some nations are fighting governments about Bitcoin, and Russia's talking about gold. Oh man, I could rant about that one for a while, but I won't because it's going to waste a lot of time, and you can see that on my Twitter. So what happens normally during a rate hike? I showed this before. This one doesn't necessarily update it over the past couple weeks, but doesn't matter. It still shows the general trends. You see that the rates increase, the green line here, Fed funds rate, it increases. Generally, the bond yields increase, but then they start to fall when people start seeking liquidity. right? And what we saw in the taper tantrum was that people started bidding up the bonds because the stocks were looking scary because they started to QT, and then they fixed their balance sheet. And then 2020 happened, right? So, and then we hit this. So we ran into a wall at just the wrong time in 2018, 2019. But generally speaking, the bond yields started to rise. Stocks were rising at first. Like we got some positive volatility, and remember, Bitcoin made its biggest runs up while the bond yields were rising, while the market was, or while the Fed funds rate was increasing or projected to increase 2016 to 2017, right? And while the balance sheet was not necessarily declining via QT, this is mostly a straight line, right? So if they raise rates, we could see the bond yields increase, right? Now, generally, I don't think there's much room for them to increase, and that's the thing I think the Fed will also avoid because the government won't be able to service its debt after 2% on the 10-year. Also, there's been no change to this trend here because it's just a taper for ants right now. $110 billion per month has continued since 2021, and no change. They keep saying they were going to taper. It hasn't happened. The market has distributed and sold off on the pretense that they would, and it hasn't happened, which also can be a setup for why we may see a bit of a recovery, simply because everyone will look at the balance sheet eventually if they're making their bets based on the balance sheet and go, oh, all right, this isn't happening. Now, depending on how they come out tomorrow, could establish that this is coming. They just are being really, really slow about it to avoid true market panic, right? They're also, I think, afraid of the evidence that there would be a liquidity crisis if they try to taper or raise rates too fast. And so let's go over gold. Gold has been on an uptrend. I have been saying this over and over, is that it may not be it. This may not be the breakout, but we saw the GLD, which, by the way, please don't buy the GLD. Not necessarily financial advice, but it's basically you as an individual investor can't receive gold from it. So if it's the only thing you can buy, you can go buy it. But buy PHYS from Sprott. Then you can actually receive the gold after you have a certain amount saved. But anyways, the GLD had the highest inflows in dollar amounts since its opening in 2000. That's crazy, right? And gold kind of budged, right? We've kind of been on an uptrend. Now, we could see it really start to rocket up once we break out. RSI isn't even overextended yet. We could see it come up, come down, reset, and then start a move to the upside. And these moves can be explosive. You can even just see on this, past like 6 to 12 month chart that the upside moves can be much bigger than this, right? So we could come up, but and we are seeing volume increase. So if we're talking about being an accumulation zone, we're on the end phase of the accumulation zone. Now, the thing that tells me that we're not necessarily there yet, and we could become it, but we're not there yet, the gold miners index is going down while gold is going up, or the gold miner index is falling below what gold's achieving, meaning that long-term investors are not interested in miners, which means this isn't a strong rally. People are interested in physical gold as a trade itself or insurance, and they aren't interested in companies. So if they're not interested in gold miner revenue, this isn't a gold bull market run just yet, but it could transfer into one by seeing the GDX start to just rally along with it. So we'll go the gold versus the S&P 500, as I've generally said, and if you've seen my hypothesis and discussion on how gold responds to an inflationary monetary system, we may be in the transition period finally. We saw a couple of these smaller transition periods where there was a downtrend. We broke above it. We sat on top of it. We kind of wound down a little bit and then went up. This is when gold bottomed out, and then from there we've had rallies since then. Again, against the S&P 500, break out, come up above, set above it, move up. We haven't set above this long-term downtrend, but on the shorter term, we did break above it on the weekly, which means that we are seeing a general uptrend begin. Maybe this was a bottom in gold against the S&P 500. Unless we get some type of crazy blow off top in the S&P 500, then we can see another wick down. So silver, I have been ranting about this one for a while because I've been following it. The only thing I will say here is that if this was the selling climax instead of the signs of weakness or initial selling point, then move everything back, and this is our final accumulation. We'll get that answer by, we will see price consolidate up here and volume increase. We are seeing volume increase on the way up, but I wouldn't get my hopes up just yet because I think that we go along here. And if we see a blow off top in the Nasdaq, now it could be a melt up and everything kind of just works its way up. And then through the crash, this moves up. And you go back to like the 2000s, silver and gold kind of fell with the market, but then just kept moving, right? So the outflows from the stock market moved into precious metals, which then fed the rest of the commodity cycle. And you can pause this and look at all the crazy stuff I have on my chart here. But overall, it's just hypothecating where different events can occur. So we have the next talk coming up here, and we may reduce the purchases and talk our rates. We don't know how that's going to go, whether or not they're going to go up or down, but so far we've been on track here. Crude oil. Okay, I posted this long-term uptrend about crude oil a little bit ago. I saw this from somebody else, another trader, who, macro trader, who pointed that you could go to like $350, and I was like, wow, you actually could. Now, this is just a potentials thing, right? This one scares me. I like my petrol cars. I like my gassers. But we could go to really high numbers. Now, that said, I think we're due for a pullback. You go over to the daily and you realize that we broke the uptrend. We're rejecting off of it. We'll probably go down in the short term. But in the long term, we could see us spiking up, especially if there's a war with Russia that could make oil prices skyrocket. Also, commodity supercycle could push oil prices way up, especially if productivity drops due to credit defaults. So these are all things to watch out for, but I would start preparing by taking large amounts of your wealth and placing it into things that perform well in these chaotic events, because that is what I am doing. So, and then we go to copper. Let's go to the macro here. I posted on Twitter a nice little long thread about how copper could go to $6 within the next year, probably the next 6 months, based off of David Hunter's statements about it. And look what's happening. So at first I was like, maybe this would be a distribution. So I drew these lines. And I was like, maybe this will be a distribution. But then I started to go through the Wyckoff stages. And I was like, nope, we're not seeing signs of weakness work out. We're seeing higher lows. We're seeing sustained support here. And we're seeing an uptrend in volume. So we are probably going to the upside. But we have to break out above this. So if you're going to take this as a trade within this year, what I would say is you want to see that we're going to start moving to the upside. Now, this move can be very powerful. Here is 2006. This was when peak copper was achieved, meaning that we were mining the most copper ever, and we still got this massive move. 79% in 95 days. Wow. So this would actually not be an insane move. This would actually be a very reasonable move over the past, 17 years. I can't do math that well. Let's face it. I can't do that quick in my head. But since 2006, we've been in the same price ranging. So why not? Why can't we go to $6 finally after all this inflation and all these limits? Remember the LBMA, the London Bullion Exchange had back in, I want to say it was actually September. I guess it's October. The copper price rallied. They ran out of copper at the LBMA and they had to stop trading. Guess what? Just because they got certificates of deposit from the COMEX does not mean they ever got the copper. There's a shortage of copper as far as producers are concerned in this near term because of supply chain limits. Now, it doesn't mean that this has to be a permanent move, but we could go to $6 pretty easily just on a speculative run. And that could go with tech stocks being run. So this is a much safer move because unless you're going to get massive deflationary pressures, which even then doesn't necessarily have to drag down copper too hard, your asymmetric bet is 30% up, maybe 10% down, but you can hedge against that by just having stop losses that follow the general bottom trend line. So you can play copper. I think that this one is a good setup, and I will be watching it. This is going to be one of my next big moves this year. So it looks like metals are on the menu. Okay, finally Bitcoin. Whew! All right, so I said a couple weeks ago, 3 weeks ago or so, if we broke down below this area, I was going to get very cautious. And then last week I said if we break down below 40,000, like that's it. That like this is going to take a while and this is going to hurt. Yes, all that happened. So you can hear the hurt in my voice because I really was hoping this would hold up here. And this is where, so you got to watch your ego. I spent the past couple of years looking at how the Bitcoin, well, yeah, a couple of years, looking at how Bitcoin correlated to different markets. And I found that 2020, it had correlated to bonds and gold. And then when gold broke from bonds, Bitcoin correlated to bonds. And so I was like, oh, this is following bonds. Well, what I think occurred here is that we saw derivatives action really drive this last move last year, the second move last year. And the derivatives are probably the result of the Wall Street guys trying to bid up the price because they're just playing the gambling game. And man, like these Wall Street guys are so bad at their jobs. They lost money throughout this move. I'm not saying some didn't make money, but what I am learning over time is that most of these guys are just as bad as any guy that just puts some real time into learning how markets work. So the Warren Buffett statement that most people can't outperform the S&P 500, it probably rings true because most of these hedge funds can't beat Nancy Pelosi. So let's be realistic here. We are just going to keep seeing them play this bid up and down. So, but overall, I think there's pretty good support in here. But that doesn't mean that we can't go to 32 to 29 and even down to 20. And I'm not going to say that the 20 is likely unless we get a massive deflationary event. I'll show you a few reasons why. So far on the macro trend line, I am not really macro long-term concerned unless we break below this bottom line, because that would be to me a signal that something is fundamentally wrong. And I don't think it's just deflation, right? Because this would fit the trend of how people view Bitcoin. Now, Bitcoin's going to perform best in a high inflationary, high speculation environment, not necessarily growth, but high speculation. Now, I know that it being a vehicle for speculation makes people very nervous, and people want to bash it for that, but that's part of both being tech and being a form of money. It is money by definition. You can argue it all you want. By definition, it's money. I don't know what to tell you other than like, look, pull up the definition, you'll find out. But it is technology and it's a network. And so Gresham's law is generally the argument that we follow on the S-curve of adoption. And so what I think is happening is we're seeing the tech adoption occur here, where yes, Bitcoin's falling down below into these low bear market trends, but this may be a bear market. This may have been a bear market since we peaked out here in May 2021, or February, March 2021. So, but that said, that's not really a bad bear market. And if we hold up this trend, I'm going to be very happy because we can move up. I've seen people compare this to the S&P 500, 2000, 2008, and then now. So what if we see that? Got it, cool. But overall, if we stay within this channel or stay above this bottom line, I'll be pretty happy. But if we break below it, I'm going to get extra cautious. But the thing is I'm already in most of my spot positions. I'm not going to be letting go unless we see a violation of this long-term trend line and I start seeing some long-term network failures where I'm like, there's a problem here with the network being adopted. So as an investment, I would see it as a problem. As a form of currency, if it's not getting adopted, then why bet on it? But so far, the adoption's strong. So on dominance, we're seeing that Bitcoin is holding as a reserve asset in crypto. Surprise, surprise. Come down, we're breaking back up, right? If we see a massive blow up top rally and speculation, I want to see Bitcoin dominance fall, right? I want to see that. I want to see everything else seem as speculation, and then let the stock market crash. Bitcoin price have gone up, Bitcoin price crash, and then accumulation continue, adoption continue. Finally, price follows, right? Long-term view, got it, cool. On a trading side, there's no setup here. Sorry, guys, not on Bitcoin itself. Even most of the traders I follow can't find anything to start with right now. So I'm just buying spot, and most fundamentalists are buying spot. But dormancy flow, look at this. Here's a good indicator for a bottom. This is Bitcoin moving from liquid hands to illiquid hands, right? When it comes down on these bottom indicators, it is almost always a bottom range on Bitcoin, meaning that the selling has finally given up and it's gone to the illiquid supply holders, people like me who go, I'm not letting go of this unless something severely wrong changes, right? Like the people who truly believe or who are just, mentally incapacitated. But ultimately, the illiquid supply is constantly increasing. as I've shown before on Twitter and on here. But the move to liquid hands has absolutely hit a peak. It could go even lower. We could still see price fall a little, but ultimately you start setting a floor when you hit these points, right? So just something to look for. If you were looking for a point to start stacking, this to me is one of the better indicators of why you should start stacking. Here's another thing. Are we in a bear market right now? Look at what normally happens when we see the HODL waves, right? This is the illiquid versus liquid supply holders. And again, we're seeing these waves where at these bottoms is usually the absolute peak. So what if that was the peak range of speculation and now we're moving into a bear market? Possibly. But ultimately, when it comes down to it, I'm not too worried about this because we looked at the last thing and it's like, okay, I think we could hold the support here. Now, again, deflationary liquidity crisis, big concern. Then finally, Bitcoin exchange outflow volume. We saw massive exchange flows, meaning that people are taking their Bitcoin off exchanges into cold storage. They are taking it away from being able to be traded, meaning even if it's not necessarily an illiquid known wallet, it's moving to somebody who's less liquid than being on an exchange. So that's a good sign. And then lastly, altcoins. So I brought this one up before early last week, and then in my last video, and then we had all this chaos. So Cardano against Ethereum held up, right? That I'm impressed by. If we see a rally, I expect this to maintain. But just because Cardano held up against Ethereum, Ethereum still fell like 30%. That's bad, right? So I got out of this one, like, let's be honest, things got rough, and so this is only a good trade if everything's being positive. But on the plus side, if your goal was to accumulate Ethereum and you had held this, well, you accumulated more Ethereum, would have done more by holding dollars. But Cardano holding up pretty well to me means that we are actually at a limited point in supply because people are adopting Cardano and they're still having a bullish viewpoint on Cardano. Chainlink, this is my second largest holding in crypto right now because quite frankly, it's hard to evaluate all these like layer ones and layer twos and all that and whether or not what's going to win out. Chainlink just dominates on data transfer, and it's a decentralized method of data transfer. And we saw on the S&P 500 today, we saw a massive wick on data tracking on price, and that massive wick was just a computing error, basically. And we saw a hack of cryptocaps.com or something, one of the websites where most of these exchanges pull their price data from by sharing it there. And because that data got hacked, everything got disrupted. But guess what didn't get disrupted? DeFi. Why? Because the price there's nodes everywhere telling you information. One goes down, the other one's up. You have the Borg of information. And so Google likes this. So I like Chainlink. I have been accumulating Chainlink since it was around $9 to $7. So I have a hard time necessarily hating this. But at the same time, I understand that once we broke this uptrend, this trend had followed along with wallet adoption. And we started seeing a divergence in wallet adoption versus 2021 because the VCs, the producers, were selling in order to fund productivity on the network because they're coming out with a whole bunch of new ideas and projects on it to try to advance the network, which is good. But much like a company selling stock, that hurt the stock price, that hurt the Chainlink price. So I think the adoption for Chainlink kind of remains regardless of whoever wins out this, layer. But Chainlink itself will probably stick around. So I apologize for how long this video was. I wanted to fit as much macro data as I could. If you have questions, leave comments below. Let me know. But overall, I think that we are set up for a crazy rally. And I know that may shock some while others have been expecting it. But we want to watch out for all of our risk, and we do want to hedge. So if you didn't hedge throughout this chaos, learn from this. This is the same way I learned, which was somebody telling me, hey, you should have hedged after the fact, and watching people tell me I should have hedged before. So thanks for watching. I'll see y'all next time.